Today's Monday, January 5th. This is Brian Kasal. I'm here with the outlook and commentary for the beginning of 2015, the new year. So Happy New Year, everyone. 2014 was a decent year. The economy started to heat up. We'll talk a little bit about that. The S&P ended up about 11.4%, and the Dow Jones Industrials up 7.5% for the year. So it was a good year, not a great year as far as market performance, but it wasn't a down year, and that's an important aspect of it. I would like to characterize the last couple months as a title that was used in Houston, at Houston Control: we have liftoff. For the first time in 5.5 years, it feels like the economy, we have liftoff. We've had a number of changes where the gross domestic product, which was kind of stuck in the 1 to 2, maybe 2.5% range, is now starting to break out into 3 and 4%. The last revision of the third quarter was up 5% for the third quarter. So we'll see how the fourth quarter comes in, but it does feel like the economy is getting a little bit better. The jobs numbers are better. Now, normally we have seen jobs numbers where there's job growth in the 200,000 jobs per month of additional jobs. We're now in the 300s, and that's really good. The Reagan recovery, by contrast, during the 8 years of the Reagan administration, there were 27 months in which we had 300,000 jobs or more, and even in the Bush jobless recovery, we had 7 months where there were 300,000 jobs or more. Now, we have to realize also that the population is about 25% larger than it was during the early days of the Reagan administration. So really, to have the same impact on the economy as the 300,000 plus job numbers back then would have, we need north of 400,000 jobs at this point. So the stock market has been rising. It rose substantially in year 2013 and then nicely last year as well. And so for many years, the stock market's considered to be a signaling mechanism. So it's usually in advance of the economy by about 6 months. The fact that the markets keep going up is a sign that the economy will get better, and the markets lead the economy. So that's kind of playing out the right way, the way it normally plays out. We're also in a position where the American economy is one of the only economies that's really growing in the world. So a lot of money is flowing to the U.S., and as a result of that, we may be getting better markets than we normally would have if the rest of the world is doing better. Not a single major strategist has a projection of a down market, although we do read a lot of newsletters from strategists who are very negative here, and they think that the market's overheated and they're predicting decline. Unfortunately, because we really don't know how this is going to play out, we're somewhat in uncharted territory. Investors just have to be really smart about how they play their portfolio, and we'll talk about that in a little bit. But the big story is oil. So oil dropped from last summer by 50%. In fact, just this morning on January 5th, oil, West Texas Intermediate crude, broke $50 a barrel. We haven't seen that for many, many years. The good news to that is the folks who are most affected by the price of oil would tend to spend some of that extra savings. So they estimate about 80% of that addition in their pocketbook is going through into consumer spending. So the retail sales numbers were up. So I guess as financial advisors and fiduciaries, we would always recommend folks always have a plan. And the plan would be only put at risk in equities and commodities and real estate and other risky assets, those assets that you have a longer time frame, 3 to 5 years at least. That way you can manage through a market cycle. And the areas of investing where you don't have time, where you need that money and make sure that money is around, should be in lower risk cash, maybe short-term bonds, things that are going to be safer. If interest rates rise, bonds will take a hit in price. One way to hedge that would be through floating rate bonds. Also, many bond investors are looking at alternative style of income securities like MLPs, so master limited partnerships. So we have reasonable knowledge on those subjects and be happy to talk to anybody about that. We also run some dynamic allocation accounts that will automatically raise cash if there's a rough market. So that's one way to automatically have a governor on your portfolio, on the risky side of your portfolio, to make sure that you don't lose significant dollars if we did have a big decline here. It seems like the market wants to go higher, but it usually always seems like that until it starts to go down. So we don't really know. But anyway, those are our comments for now. We think the economy is actually heating up a bit here. The market should go along with it, but it doesn't necessarily need to, but we're certainly hoping it does. So welcome to 2015. We'll have a lot more commentary. We'll look for the written part of this commentary on our website at FourStarWealth.com, and feel free to call us if you have any questions, thoughts, ideas, or complaints. Thanks.